This conference will now be recorded.
All right, so good morning. I just want to do a quick one here this morning, just because the market had a bit of a change to it yesterday, right? We ended up with a pretty big spike down, which we kind of talked about in our webinar yesterday. That oftentimes when they hold the market in a tight range like that with high volume, it can lull traders to sleep. And next thing you know, they'll break it either to the downside or to the upside, and everybody's kind of sitting there asking questions why. So. Hopefully some of you did well with that. I mean, those are some pretty tough trades to get into early on at least. So um, we're going to go ahead here and just go over a few things, go over the spike, the rules and the meaning of what a spike is, kind of how to determine when references start to lose their context, how we monitor the market for change. So now that we've broken, back into the spike that we've been monitoring, how do we monitor it to see if we're actually seeing true change or not? And then the biggest question I've gotten in DM is why are we not just looking at as this is coming back into a 4-day balance, and why I chose the context of the spike being more important, and how that's worked out so far. So coming into today, we'll get into the Globex session here in a bit here as we do our morning prep later on in this webinar. But first and foremost, we want to go kind of review what we talked about late yesterday in the webinar, and kind of why, now did I think this big of a move to the downside was a possibility? Not really. I definitely thought, a retest to 88 was possible, but I thought, this move was probably a stronger possibility to the upside. But the reason for this, again, the reason for this move and why this move set up as the highest odds, and it's very important that we don't just lose sight of this, because again, this is kind of where I come to, and this is kind of one of the biggest reasons I wanted to do this, was I find a lot of the references, the weak references, poor references, they kind of get a vanilla flavor to them, right? They're talked about so often that a lot of times we lose sight on what they're actually telling us, and when we need to pay attention to what they're telling us. So remember, we talked on this day here, which was Monday, and we talked about this, being the strongest odds move to happen on any kind of move to the upside. And the reason we talked about that was because, we had a poor low, and we had these three that came in an exact reference, which was that 03 reference, which comes from our overnight trade. So this range bound level here was built off of the overnight trade, and then we monitored it the next day. So we paid attention to this in the market. It still showed itself as being relevant. And then you get these late moves, right? These late moves, which are trying to take out a weak reference. So we had momentum buyers buying the market up and continually buying the market up, which goes hand in hand with what was happening in the Globex session. You just had constant momentum buyers protecting a certain area and pushing the market higher. And then the following open, we had the same thing. You had momentum buyers that were able to withstand any of the selling pressure. They were able to pull the selling pressure and push the market back up. But they were never really able to get anything, right? We came into this week with an idea that our 36.24 level was going to be very important, being last Monday's value area high, hadn't been tested before. So we came in with a great level on the upside. This level was given to us by the Globex session. So we had an idea on what we were looking for on a contextual side of the market. So when this happens, so when we get these poor lows, and you're saying, well, why, what was different, right? What was different from this day where you were looking to fade, any sort of a spike to the upside, compared to, what we saw yesterday, and why was it not the same context? Why were you not looking to fade any downside move, or why were you not looking to fade, here or here, to take the market the opposite direction, to take these poor references out? And that's a big thing with understanding what the market is actually trying to tell us. So the biggest difference between the two is this is sellers getting stopped from trying to push the market lower, which matched what we were seeing in Globex. So nothing had changed between these 2 days, right? These 2 days, the buyers kept buying the same 603 level, and they tried to spike it above, a very important reference that we had. So what this is actually looking at on our side is it's not just this day, okay? And this is going to carry forward. What's actually happened was the Globex session started the week buying. Our session continued the week buying. So I mean, yes, sellers were looking weak, but buyers are buying the exact same level. They're buying the exact same reference over and over and over and over again. Okay, not just a few times. 1, 2, 3, 4, 5, and then you get 6, 7, 8, 9, 10 times where it traded right within our range, and they consistently bought it up. So this is already starting to weaken. Remember, the more times you test a level, the weaker and weaker it's going to become. So that's why I thought any spike, end of day, trying to take out, the sellers that pushed this down from that reference to begin with, was a fadeable opportunity, because this market showed no true buyer in the market. It just showed continuous momentum-based buying like we had in Globex, momentum-based buying like we had in the day, and any kind of aggressive move to the upside was a fadeable move based on the references we were given. Now, the difference compared to what we have now and what we had yesterday, and why my bias was to this market breaking when we were just trading in a tight little range here, comes from what we saw there. So I knew, as we look forward, we already know how strong this 603 reference level was. It's pretty much been spot on for what we want it to look like, for monitoring the market for a bid or an offer. It pretty much worked as the midpoint of what we were expecting to see with our trade. So we're already aware of this. We already know that they're trying to buy the market above it consistently. We failed once already above our 36.24 level. Globex wanted nothing to do with a break to the upside from this level. We talked about this being an incomplete auction to the upside. So this auction just doesn't look completed. It still doesn't, which is something you should write down and carry forward with you. Globex again failed at this 36.24 level. And then we don't just get the one poor high, okay? There's two references here. The initial poor high that we grab and then pull back in D period, followed by a secondary poor high in the exact same profile within, the early trade, tells us one thing, and that tells us that the buyers who are buying this area here are tiring out. They're tiring out. They're not getting what they're looking for, because what they're looking for is they're looking for a break above 36.24. It's the same thing we're looking for. They're looking to get above the value area high from last Monday to be able to rally the market to a new all-time high. And what's happening is when you start to get an incomplete profile like this, where there's no tail, right? There's no excess, there's no tail to this. And then you get the Globex session failing at that very prominent level we've been monitoring. And coming into the next day, you open up and have not one, but two back-to-back poor highs. This is a sign of true exhaustion for this move to the upside. It's not an overall sign of exhaustion. So that's the biggest difference to how I view this compared to if we would have got, very good excess. Very good excess could be a strong market reversal sign. This is more just an exhaustion sign. This is the buyers they gave up. They had enough, and you could see it. And we talked about, it looked to me like somebody was in here repositioning themselves or positioning themselves for the next move in the market prior to Friday. I think that's what we got. We got, the repositioning. The momentum traders were trying to push us higher, and somebody was in here just allowing them to push into them the whole time. And while they pushed into them, they just sat there, absorbed. And then finally, when these momentum buyers gave up, and it's not just the ones from today, it's from this Globex session, this day, and this spike here. The same buyers are in the market. And that's why we mark levels like this, especially when they are given to us early on in the week, because it gives us a great reference to contextually look at the market on where the majority of trade is trying to take place. So when you look at that level and you just forget about after I period, when you look at that level, and I can't bring Globex on here, but we know Globex traded the majority above it as well. Look at how much trade was done above that level compared to how much trade was done below it, right? It's very, very obvious that they're consistently trying to buy above this level and they're trying to push the market higher. So all that put together, so from our Sunday plan to our Monday revamp plan, all the way until yesterday, you take all the context that we were given and you look at the references that are built, and it gave a clear picture that this was going to be the strongest possibility because of these references all finally lining up for us. So this is what's important about market profile, because a lot of time it becomes a little vanilla and references are thrown out there and it confuses people because they start to zero in on, you know, poor highs, weak highs, etc. You know, and they're just looking for those references, but they're not looking for the context behind the references. And the context is what actually matters. The references a lot of times won't matter. It's the context that matters. And this week give us two really good examples of when, you know, a poor low or a poor high could mean two different things, right? This poor low doesn't look like it's going to hold for what we went over. This poor high looks like this is the exhausting point of the move, and then gives us, you know, an odds-based prediction that this move is bound to happen. Like I said, did I think M period would dump the way it did? Not really, but what did M do? M got back into, you know, the spike that we're monitoring, and we all know what we were looking for here. We talked about this yesterday, being, you know, not true attempts at the spike. So these are not true rejections from the spike. These are nothing more than momentum buyers stepping into the market at a very visual reference. So when you grab those buyers, all of a sudden the stops start to go, and a move like this is very possible. And that's what we got, you know, with our late day spike there. Very emotional move, which came, by the way, our low came from where? One tick below, you know, the breakout from this spike point of control. So still very mechanical. So that's what I wanted to touch on as far as the context side of last week goes, because I think it's very, very valid. I think it's very, very important. And to be honest with you, the last 2 weeks have been a phenomenal learning week. This week especially, because it gives you a real glimpse into how market profile seems like a complex tool to use. And a lot of times I make it complex in my own mind because I'm overanalyzing, and that's, you know, that's not something you want to fall into with overanalyzation. Is simply take the information the market has given you, and then when it gives you that information, you can make an odds-based decision on taking a trade or stepping aside. You don't have to take this trade. You can just monitor the market to see what happens. That's what I did yesterday. I didn't take this trade. I just monitored the market. I wanted to see how we would respond once we got down to the spike. And once we got down to the spike, it looked like we were going to start moving up, and then, you know, the dump happened. It's okay to miss those. Like I said many times, if you want to step aside and just monitor the market, it's perfectly fine. But overall, I think the context set that move up very well yesterday. So moving into today, we want to talk about the spike. We want to talk about spikes and spike rules, okay? So a spike, and this was in the pre-recorded for those that got through them. A spike is simply just a move outside of the body of the profile late in the day, okay? So L or M period. The reason it's considered a spike is because it's moving strongly in one direction, either up or down late in the day. So it's an emotional move, right? This is purely emotions. A lot of this is probably a stop run, and then, you know, momentum sellers piling on, trying to push the market and really get it to collapse. And what you get is you just get rotational moves down, because you're going to have buyers in here who are trying to protect the market. And what happens with these buyers when you have, you know, more sellers is simply they buy, they stop out, they buy, they stop out, they buy, they stop out, right? And it allows the market to have a more aggressive move to one direction or the other, yesterday being to the downside. So with a spike, I treat a spike very much like I treat balance as far as how I trade it. I'll trade it as a fail look below and get long. I'll also trade it as, you know, a go. If it breaks lower, that's very negative for the market. It tells us the auction needs to continue lower. And likewise on the highs, if it breaks above and fails back in, I'm looking to fade it back to the opposite side of the spike. Or likewise, if it breaks out, I want to get long with it as a rejection of the spike. So When we look at the spike, the strongest area of reference is going to be your base of the spike. That's where the strongest support or resistance will be depending on the direction. So if you're on an upside spike, this is going to be the strongest support for any move down. In our case with the downside spike, this is going to be the strongest resistance for any move back to the upside. So very important that you monitor the base of the spike. When drawing your spikes, there's going to be different ways of drawing it. So the way I drew this one is I drew it right from when M makes a new low against J and then goes down. And the reason for that is, in this case, I and J period auctioned down, and there was a secondary auction here. So this was a valid low at one point, right? Good access, valid low, L period auctioned us higher in J. So this area here had an opportunity to be traded back through. It was only M period that, you know, broke this low and then really went. And this where I have my base drawn, you know, just around 87 to the low, is the area of trade that took place late in the day that didn't have an opportunity to be either accepted or rejected based on the time that it went. So that's how I drew my base on this one. Now I drew my base differently for Monday, last Monday, and that's a different reason, right? The market traded, like I said, valid low here. K period starts the auction down. This is an outside bar. So when L makes this new low here, and M period retests that body, this inside, this lower value area here, and this fails and then breaks down, I actually want to mark, you know, from where L and M and D period are one, because from L period down with M period, because this happened late in L period, right? I went back and watched this day. This is a late move in L period. M opened here and then it dumped. I need to be monitoring up to this level here. So there's going to be different ways to mark your spikes, and it's not going to be just a one clear coat way to do it. But what's very important is you visually see, where did the market finally give way, and where do I need to monitor for, you know, the late trade that didn't have enough time to be either rejected or confirmed. So very important when drawing spikes is where you put the base. The base is the most important aspect of the spike, so that's why I say that. Now that we've broken into, you know, the spike that we're monitoring, there's a couple things we want to monitor. Okay, one, the spike bounced right from our low. Again, is this shocking to me? No. When we draw proper spikes, you're going to see reactionary buying and selling, whether it's buying in the spike or buying from the base of the spike, or vice versa on an opposite upside spike. It's going to be very clear, you know, where the levels of support and resistance are. So now we're opening, you know, we'll probably open somewhere possibly on a little gap inside our major contextual area. So this area is what we focused on the entire week. We traded above it the whole time, and somebody had asked yesterday about the rejection. This is perfectly okay for me. I have not turned full bullet bearish yet. I will if we get below this level here, and this level here is last month's high. Okay, what we talked about in our OTF session 2 days ago, we're breaking out of an inside bar right now. So October was an inside bar to September. November has tried to break to the upside from that inside bar. Finding a seller below this level is very negative for the market. It will probably cause, you know, strong liquidation to the downside. Doesn't mean it's going to. It's an odds-based system. The odds would favor if we do find acceptance below here. So not just trade below here and then come back up, or, you know, come here and then come back up. I'm talking actual acceptance. And now an easy way to wait for acceptance or monitor acceptance is if we come down and we have multiple days trade within, you know, a tight little balance range. Remember, trend to balance, and then the market breaks. All right, it gives you an opportunity to say, okay, we failed this level now. And this level becomes major resistance to the downside. So if you don't have last month's high marked on your chart, you need to mark it on your chart prior to the open today, and carry that forward with you for the remainder of November, at least, if not into December. This is the most important go or no go line at this point. Holding this level, we just start to move back up, and could very well happen. We talked about in the webinar yesterday, I like to see, you know, a body of a profile build inside this spike and then either choose to break out or reject and move back to the upside. Until there's another body built in this spike, I'm not considering, you know, this reacceptance into the spike or not, especially when we're doing it on, you know, an emotional move late in the market yesterday. I want to be able to see some sort of profile build here, which will give me a better idea on the context moving forward, if we're going to actually liquidate to the downside, or if we're just moving into an area where we can find support again and then move us back to the upside. So that's how I'll view today. That's what I'm looking for today. It doesn't mean it'll happen. We could easily open and liquidate, and if that happens, so be it. And how that would look is, of course, a period would open. You would get very little above our open, and the market would start a steady decline to the downside at not a furious pace. So if we're going to have an emotional sell-off, it's going to be very quick. This will be a very quick move. If we're just liquidating and it's just, you know, it's just larger players taking profit, this will be a very casual move to the downside. They'll move it, it will go a significant way. But if there's to be more liquidation, watch the tempo of the market, watch how they're bringing the market down. It will not just be a straight shot. A straight shot is very emotional, is more momentum based. If they casually bring the market down like this and it's, you know, back and forth, that's more OTF getting out of their positions, at which time we always want to be monitoring our volume to give us an idea on who is our competition on that day. So that's how I do my spikes, look at my spikes, and how I'm going to monitor the market here today for change going forward. Can't lose sight, sorry, that OPEX is Friday. So there is still going to be larger players at play. There should be. Like I said yesterday, I believe this was repositioning and or profit taking in a smaller sense for profit taking, but more repositioning for the next move in the market to occur. I won't be shocked if we see more liquidation today, but of course they're going to have a big battle just down here around 35.41. So some pretty big levels again to monitor today. The market's giving you a lot of references, a lot of context to work with, and I think as long as we put it in the right place, like we've talked about, we'll be, you know, better equipped for any type of move the market gives us today. I had some questions in DM about why did we mark this spike? Why did this spike from last Monday matter more than just this 4-day balance, and why did you mark the 4-day balance but not monitor the 4-day balance? So I think effectively what the question is why am I not looking at this as just, you know, a failed break above the balance, and why do I think that this context is actually what matters still? Like I said, you know, earlier in the week, I was marking this for a longer term reference point. That's why it's a different color and I don't have it as a true balance range, is because to me, the true context came from the failed attempts 1 and 2 below this attempted spike. We traded inside, then we tried to break above, and this now would effectively be, you know, 1, 2 days above and then breaking back inside. So when you look at it, the market overall, and what I'm going to do, you know, probably by the end of the week, if we trade to here and then finish somewhere in here, is this cannot just be a 4-day balance anymore. This balance would have to be this day to this low, and this would be a multi-day balance, not just a 4-day balance. That's why I didn't mark this 4-day balance as being a reference for my trading, but more as a longer term view. I don't think the context is there yet for this to be considered a 4-day balance. I think that there's still more trade to take place. And if we come down here and catch a bid, and then Monday we're somewhere in here again, it'll be the same thing. I'm just monitoring for longer term balance. For me, coming into this market, the most important thing was last Monday's spike, because of the way last week traded in and around that spike, and the fact that we never really tested last week's Monday's value area high. This was still very relevant coming into today. So then you may ask, well, how long will you leave the spike on? And how long does that reference stay relevant? And quite simply for me is this reference will stay relevant until we've traded through it and I feel like the spike has either been accepted or rejected. Of course, acceptance of this spike, the market will move lower. Rejection of this spike will be another break above. So now, if we are to open or trade within the spike or trade below it, I'm looking for, either this play in a day or two to get long somewhere with this break and rejection of the spike, or I'm looking to get short with the acceptance of the spike somewhere for a continued move to the downside. So today might be a no trade day for me simply because I think there's going to be a lot of information given. And I think, it might be better equipped for my style of trading just to watch the market, take some notes and prepare myself, for one of those two possibilities to occur. It's okay to sit on the sidelines. You don't always have to be in the market. You don't always have to trade, especially when we're in an area where we should see some sort of change here occur in the next few days. So that's why I'm not monitoring that 4-day balance right now. I just don't think it's relevant quite yet. So hopefully that answers the question that was sent to me in DM. I don't know if you guys have any questions, anything you want to go over just on the stuff we've covered right now. If not, we'll move on to the morning prep. But for right now, if you guys have any questions in regards to spikes or last month's high, the inside bar, or the context of how we got here, feel free to ask that now.
Can you just talk real quick, repeat what you said about the difference between what it means for the tempo if we open and like go down quickly versus slowly, and also what it would mean if we did it in the reverse to the upside?
Okay, so there's the two biggest differences between a long liquidation day and a short covering rally is tempo. So to split those up first and foremost, a long liquidation day does not usually open and just die, okay? Because it's larger money taking place in the market. This can occur, and when this does occur, there's usually a catalyst in the market, and what there is there's momentum-based sellers that are in the market as well who are pushing with OTF, and they have to just move the market faster because there's too many orders coming in. When you have short covering usually starts, tight. You're open maybe here or somewhere in the middle. Usually starts tight, and then all of a sudden it will pick up steam and it will just get going right away. The tempo will be very quick once it starts the rally, because we all know when stops start to go and sellers keep selling, they're doing the same thing that we had in the spike yesterday. So a short covering rally, the move in A period is usually fairly quickly. It might not come, first thing in A period. It might not come in the mid A period. It might come in the last 10 minutes. But when that market finally moves out of a somewhat tight range where it's building more steam and it starts to go, once it starts to go, the tempo will be very quickly, very, very quick, to the upside. A true long liquidation day, which is we saw them just a few weeks ago, prior to this move to the upside, it's very casual, right? It's a very casual tempo. So instead of the market doing this, like just look at those as pullbacks, right? These being your pullback areas, a very aggressive, quick tempo to the downside. They'll actually just pull it down, casually, just move it up and down and up and down. They'll still take the market down to the downside, but they're not doing it in an aggressive manner, because what they don't want to do is attract momentum-based sellers to start selling the crap out of the market, and they start losing the ability to take their position off. Because keep in mind, a long liquidation day is nothing more than profit being taken, okay? So the tempo on a true long liquidation day should not be super aggressive in nature. It will go a distance. You could get 20, 30 points out of the first two periods or more. So it will make a big move, but it will almost seem like the move snuck up on you in a way, if that makes sense. Like once that move is done, you'll be like, yeah, you'll have a feeling that it was just casually brought down. It'll be casual selling. It won't be an aggressive just sweeping the bid, or the bids just lift and they just completely dump the market off. If you are to have momentum sellers enter the market with OTF, this can be a very fast move. This can open and just completely collapse, and you'll see it on the DOM. You'll see on the DOM that the offer will overwhelmingly be stronger than the bid. And a lot of times the bids will just be stripping away, which leaves less ammunition for them to effectively sell their profit into. So that's the three biggest differences between the tempos on the days that we'd be watching. It's a good question. Any other questions you guys want to go over, just in regards to the stuff we've covered so far? If not, we'll move on to how I'll do my morning prep today. I'll do it with you guys. Obviously, I've marked my references out already. But what I'll be looking for early on today, like I said, any move towards the spike base, I want to monitor for rejection or break above an acceptance and a continued move higher. And likewise, I really want to pay attention to 41 coming into today. I really want to know what's going to happen with this. Biggest thing, and the one thing that can catch a lot of people with a larger inside bar break, so a monthly inside bar break, is this break can come deep under the previous month's high. Okay, this can be a deep pullback, and then you'll get a rejection or a retest. My biggest thing is this: if the market's going to reverse when you break back into this market, doesn't matter how deep it goes, they're going to at some point make an attempt to get back above it. I want to wait for the attempt before I get overly bearish in the market. So yes, I would take a sell here. If the market was in my favor, I would sell the market and try and catch, that initial move down. But I'd be very aware that it doesn't matter how deep this goes, there's a strong possibility that they're going to reattempt back up towards that previous month's high prior to finding true rejection. And it might even get above that high and then break back in. So that's what you should be aware of on a larger time frame inside month break, is that it's a month, right? There's a lot of trade in a month. That's why I still have, these important references here and this bigger box down here, because these are areas in October that served as, good pause areas or good resistance areas. And that's why I left a lot of these markings on there. So just keep in mind, if we do break, and that's kind of what I'm watching for, and that's why I say I'm okay with monitoring the market today and not so much trading it, is because I think I'm going to get a lot of information today that I may just want to sit back and take in, rather than, have my mind effectively looking for a trade or monitoring for a trade. If I can just sit back with my notepad and my pen and take notes on what's happening in the market, it will better equip me to take on the market, when one of these moves actually occurs. One thing I would point out here is the fact that we had this emotional spike. Keep in mind one very important piece of information we need to continue to have is, quite simply, we talked about it yesterday, this point of control, this point of control, and this point of control, plus all of our value up here. I mean, this value did drag late in the day, is still fairly balanced up here. It's a good break from balance, but we do know, we have an incomplete profile up here, a weak reference here, and poor highs that built here, which gave us, short-term bias to the downside. But it's something we need to carry forward with us, that this could be nothing more than a late day liquidation. So I would not also be shocked to see a short covering rally and be back above this 35.88 level, especially with Globex not really doing anything but balancing. So those are the main things I'm watching for today. Like I said, I'm more of an observer today. Remember, trading is a job. You want to treat it like any job. If you're going to go into a major presentation with a partner or with somebody of another firm or somebody who's looking to purchase your business, you're not just going to walk in there without doing prep and just hope for the best because you've done it before. You're going to take the time to prep to give the best presentation. Trading is no different. Treat trading like a business, and for the business that it is, sometimes you need to just prep for the market so that you can better challenge the market when it gives you the moves that you're looking for. So that's where I'm at on the day. I think, this is a very strong possibility of multiple different days taking place. That's why I have no problem stepping on the sidelines and just monitoring and taking notes for myself. But if you're looking to get into the market today, monitor, the Globex high, the Globex low early on, especially the low, and then monitor, the spike low yesterday, which is yesterday's low. Any acceptance back above this low, you would target the spike base and probably fairly quickly. So that's how I trade it if you're looking to trade. So if there's any questions, I'll answer them now. Otherwise, we'll wrap it up and I'll let you guys do some of your own prep prior to the open in 25 minutes. And then we'll get back together again here in the afternoon and see where we're at and formulate maybe a plan for the afternoon coming into Friday. So if you have any questions on the morning prep, let me know. Otherwise, we'll let you guys get going. All right, perfect. I will see those of you in the pit, and the rest of you have yourself a great day, and we'll see you again at 12:30 Eastern.